This is TAX2601. I'm going to be looking at assignment 2 for semester 1. This is question 1. It's out of 25 marks and you should spend around 30 minutes completing the question. Remember, exam technique is very important, so I'm going to treat this assignment question as an exam question. So what would I do if this was an exam paper? Well, the first thing I would do is I would go down to the required and I would see what is this question actually asking me to calculate. Okay, so there is only one question for assignment 2. The question required says, calculate the income tax liability for Solar Lighting Solutions Pty Ltd. That's important because then you know what type of entity you're dealing with in terms of the taxpayer. And that's for the year of assessment ended 29 Feb 2020. Okay, so you've got the tax year, that's important. So we know we're working out the tax liability. In order to work out the tax liability, you need the taxable income. So I need to create my templates. Okay, the templates in the notes, we have income, leave some space because you're obviously going to fill it up with different line items, less deductions and allowances. Okay, again, leave space, you're going to fill that up, and then add taxable capital gain. Okay, and then you'll have taxable income. Right, and that's obviously what you're trying to get to in terms of this working. And then once you've got the taxable income, you then apply the tax tables, okay, or a flat rate of tax. Okay, depending on whether this is just a normal company, which is 28% flat rate of tax, or if it's a special scenario, either SBC or micro business, you're then going to apply a sliding scale in terms of the progressive income tax system. Right, so that's the exam technique. That's what you're going to have to establish going forward. Okay, you need to answer everything, obviously. You're obviously working out the tax liability, which you'll get after applying the tax tables or flat rates. All right, so that's the last step that we need to look at. Okay, so the first thing we need to do in terms of workings, remember, there's always going to be easy and then more difficult in the actual question. So once you've looked at the required and you've structured your question correctly, then you go back up to the top. And then you go down the question. You literally go line by line by line by line, and you apply the tax rules and laws according to the textbook as well as the legislation. Okay, so Solar Lighting Solutions, Pty Ltd, manufactures solar powered lighting systems in Rustenburg, okay, in the Northwest Province. The company is an SBC, okay, that's very important. That you should be highlighting. That's a very important note because now we know what type of entity we're dealing with. So if I'm dealing with the SBC, I'm just thinking about different things, right? Obviously, I'm thinking about capital allowances because SBCs are special. I'm also thinking about the progressive income tax table because this is obviously a special type of business, a company, okay, a corporation, and you're then going to have to apply the tax rules and laws accordingly, right? So any deduction would obviously meet the Section 11A deduction in terms of normal operating expenditure according to the general deduction formula. Or you could consider the special deductions or even some of the capital allowances. Income obviously needs to meet the definition of general income. There could be a special inclusion as well that you might have to consider. There might or might not be exempt income. That's something that we need to look at if we're going through the question information. Right, so again, that's just scope. I'm scoping out the question. I know what I'm dealing with. Now I'm going to look at the different line items. Okay, so the first one. The following information is provided to you for the company's year of assessment, okay, ending 29 Feb. Okay, we saw that in the required, so we know what year end we're looking at. Okay, so obviously the year would have started in terms of the 12 months, the 1st of March 2019, right, last year, because this is 29 Feb 2020. Okay, then we go down each line item. So income, they've listed 2 here. Okay, sales Right, there's no note for the sales, so we're just going to assume sales is sales. So 4256. Okay, the reason why I'm putting it in bracket is because it's a working. Okay, I'm doing it very similar to accounting in terms of structure. Okay, generating a set of financial statements. In accounting, you do the same thing. Show workings in brackets, then show final answers here. Okay, I'll use a two-column approach. Again, you can decide what format you want to apply. I'm going to keep totals in one column and I'll keep workings in another column. So the sales here were 4256. Let's just double check that. 4256, yes. Okay, for 4.256 million, obviously. All right, interest income, again, no note, so we're just going to include it as is, 28,320. 23,820, is that right? 20, oh, it's 28, 28320, 28, other way around, 28320. Interest income 28320, 28320. Let's check that. 28320, 28320. Perfect. Okay, so that's your sales income, that's your interest income. All right, again, no notes, so we can't look at anything there in terms of special legislation requirements in terms of deductions or inclusions, depending on what we're looking at, expenses or income. Okay, now we change focus. Now we're looking at expenses. So with expenses, you're looking at potential deductions or capital allowances. Right, remember the theory, general deductions, section 11A, okay, in terms of legislation, and then you've got capital allowances which are applicable to certain assets that are used by a particular business. Right, I've got rental of office equipment. Right, if I'm renting office equipment, I'm using that office equipment for rendering or a service or providing a product. So it's part of operations. Okay, there's no note here. So you would then assume, okay, based on what you do know in terms of rent for office equipment, it would be utilized inside the company. So section 11A deduction would apply. 20,000 would be deductible in terms of rent. So rent for office equipment. Okay, remember this is the rent for the office equipment. You're renting the equipment. You don't own the equipment. So there's no capital allowance here, obviously. All right, so this deduction, okay, again, in brackets, what is the amount? 20,000. Rent for office equipment. Next line item. Okay, there's a question mark next to this one, so obviously you're going to have to work it out. They say manufacturing machines, right? Obviously, capital allowances will be applicable. They don't even have to state that, right? I assume the assignment is easier, okay, because they've given you some clues, but they might do the same thing in the exam. Just look out for these type of things. So we have something important there, manufacturing machines. That's important because now you know what you're dealing with, right? It's an item, okay, machinery. It would be considered movable, okay? It's manufacturing and it's the capital allowances of that particular item. There is a note for this, okay? Notes, see, number 1, 2, and so on. Okay, so I need to go and look at note number 1. Here's note number 1. Right, what does note number 1 say? Manufacturing machines. A second hand, that's important. Okay, remember you get new and you get second hand. Second-hand manufacturing machine SS1 was purchased on 1st August. Okay, that's important. Right, remember, where are we? 1st March 2019. Okay, 29 Feb 2020. Right, so 1st August 2019 would have been during the year. Okay, so in other words, somewhere there. 1 August 2019. Okay, obviously March to Feb. All right, and that was for 270. Right, in January of 2020. So where is that? That's over here, Jan 2020. Okay, there's another date. After incurring many repairs to machine SS1, the company sold this machine for 20,000 and then replaced it with a new machine. Right, there's another machine there. Okay, so you bought a second-hand machine, SS1. All right, you then sold it on the 1st of January and you bought a new machine, which is SS3. All right, so you need to consider the capital allowances. All right, so the best approach, okay, obviously you're going to have to study these before you go into your exam, but I'm just going to show you some revision as we go as well. I'm going to refer to the notes so you guys can see what I'm actually looking at. Capital allowances, this is the section we're looking at. Okay, section 12C, wear and tear allowances on new or used property, plant and equipment, well, plant and equipment, no, not property, okay, in the process of manufacturing. That's important. Right, you can clearly see here that you've got two types of assets. Okay, obviously new or used. Right, you can even refer to the study guide if you prefer. Let me open up the study guide. Where's the study guide? Here. Okay, so if we go to the study guide, let's go to, this is chapter 6. Let's just find it first and I'll put it on screen. Chapter 6. Here, chapter 6. Right, so depending on you, you can either use what's in your notes, okay, or you can refer to the study guide, okay, in terms of chapter 6. Okay, let's go down, let's go up, actually, here. Okay, calculating capital allowances for movable assets. All right, are we an SBC? Yes, we are. Okay, all right, manufacturing, it is applicable, but obviously for normal businesses. Okay, so new and used. Okay, here, manufacturing, right? So if we go and look at the question, where's the question here? No, that's my workings. There's the question. Okay, second-hand vehicle, machine, not vehicle. Sorry, I said vehicle. Machine, SS1. All right, so let's go back to the notes, okay, and you can clearly see here, this is for normal business, SBC, special business. Here's the special. Right, section 12E is applicable for SBCs. Right, that deduction is applicable to new and used assets. It doesn't make a difference what it is. Right, in terms of manufacturing, you're going to receive a full 100% deduction. That's the important bit. So, okay, second-hand manufacturing machine SS1. Section 12E deduction. Okay, it is good to impress the marker, okay, in terms of knowing which sections these are in terms of the rules. Okay, if you just say second-hand manufacturing machine deduction or allowance rather, you should still get the marks, but again, I'm not too sure how strict UNISA is in terms of their marking. It's always a good idea just to refer to what you're looking at here, okay, in terms of 100% deduction. Okay. All right, so you can clearly see here, all right, manufacturing assets get that 100% deduction. All right, if it was non-manufacturing, you would then apportion it 50, 30, 20 over 3 years. All right, if there are any moving costs, you can also include that as well. Okay, so that's the first one. Right, how much was that purchase? The purchase was for 270,000. Okay, so this machine is going to have a deduction of, obviously all these amounts are going to be in brackets, okay, but if you look at this, okay, if I put that amount in brackets, Excel is going to make it a negative, right? So I'm going to leave it as that. Just remember, show it in brackets. It's the same as accounting. Okay, go back to the question. Now you've looked at the first part, okay? Second part, in January 2020, okay, so a few months later, after incurring many repairs to machine SS1, right, the company sold this machine for 200,000, right, and replaced it with a new machine. Okay, so if I'm selling an old machine, I need to determine if there's a recoupment or scrapping allowance. All right, so if I'm looking at the actual cost of the machine, the cost was 270,000. Okay, did I get any deductions or allowances? Yes, I did. I had the full amount in terms of a deduction. So cost less deductions would give you a taxable value of 0. Okay, your proceeds from the sale, okay, proceeds were 200,000. Right, the proceeds are obviously going to be limited in terms of the recoupment to the previous capital allowances that were provided. So How much did we provide? 270. Okay, proceeds were 200,000. So there's going to be a recoupment here of 200,000 purely because you've made a inverted commas profit on sale of the assets. All right, so we need to show that recoupment here. Recoupment of second-hand vehicle sold from. Recoupment from. Second-hand vehicle sold. Right, I think it is a good idea to show that. So proceeds, okay, minus tax value limited to capital allowances. Okay, I'm just going to abbreviate just to fit it in. Okay, so we're going to show a recoupment of how much? 200,000. All right, that we know for sure. Okay, and then you replaced it with a new machine. Okay, so I'm buying a new machine, SS33, and that machine costs 320. Again, because this is an SBC, new and old machines have a deduction that you can claim. Okay, in terms of manufacturing, 100%. Okay, new and used. Right, so if we go back to the question, right, this machine is going to be used for manufacturing because you're replacing the old manufacturing machine with the new one. So 320 will be seen as a capital allowance. Go back to here. Okay, copy paste. All right, new manufacturing machine SS3. Okay, section 12E allowance, 100% deduction, minus 320,000. All right, and now I've looked at all of this. All right, once you've looked at something, you don't have to look at it again. All right, move on, go to the next section or question. All right, so we go back up to the top. We've answered the first one. Okay, second one, manufacturing machines in terms of repairs. Right, remember, if I'm looking at the repairs, and this is for an asset that's being used to generate income, that meets the definition of a Section 11A general deduction. So, 65,000 repairs. Okay, Section 11A, general deduction formula. Okay, how much did I have there? 65. Next, non-manufacturing machines, capital allowances. Again, there's a note. So now we need to look at the note. Manufacturing machines, okay. Non-manufacturing, sorry, I didn't say non-manufacturing, okay, machines. A new delivery vehicle, which was purchased on or in, okay, December 2018. So again, let's draw the tax year. 1 March 2019 to 29 Feb 2020. When was this machine bought? December 2018. So that's the prior year. Okay, diagrams are important because of the tax year. Okay, the year of assessment. What do I have here? Let's see. Purchased in December, okay, for that amount. Was still in use, okay, on 29 Feb. So in other words, you bought this vehicle there and you're still using it up until here. So have you used it this tax year? Yes, you have. Right, new equipment was purchased, okay, 1 July 2019, okay, during the year. Right, that's computer equipment. All right, again, go back to your notes. Okay, Section 12E applies to an SBC. Right, if you look at this, you'll see it here in the textbook as well. Okay, well, study guide. Right, other assets. Okay, not manufacturing, other. 50, 30, 20. Everybody see that? Okay, so if you're looking at the deductions in terms of the capital allowances general deduction formula, 50%, 30%, 20% is going to be deductible, okay, from the current taxable income calculation. So the non-manufacturing assets would have been deducted for a 50% capital allowances in the first year, right, for the asset that was purchased here in December 2018. All right, so obviously I still have another deduction to take advantage of. Okay, so in other words, this 30%, and that'll be in the current year. Okay, so what is this? The vehicle, hey? Yeah, so vehicle, section 13, not 13, 12E. Okay, section 12E, non-manufacturing capital allowance. Right, the capital allowances would have been. I'm gonna show the working actually, okay? Because remember, it's the 30%, right? So go back this page. Okay, 289999. 28 times 30%, close brackets. Okay, so that deduction that would be applicable to this financial year would be negative 289999 times 0.3, 30%. Okay, did the question say we had to round off to the nearest rand or anything like that? I didn't see anything like that here. Yeah, no, I don't see any instructions here saying rounding off to the nearest rand or anything like that. So I'm going to keep it in terms of cents. I'm not going to round it off at all. Okay. Um, let's show all the decimals. Okay, 2 decimal places. Right, to 70 cents. Okay, so that's the vehicle. Let's go back. Second part of this was the new computer equipment that was purchased on the 1st of July. Right, remember, section 12E will still apply here because this is an SBC, because this is an other type of asset, non-manufacturing in nature. The computer equipment would receive a 50% deduction from a section 12E capital allowance. All right, how much was it? Let's go back. The cost of the equipment was 55,000. 55,000 times 50%. Okay, so minus 55,000 times 50% is 27,500. That's the computer equipment capital allowance according to section 12E. Right, so now that we've looked at that, cross it out, move on. Next, bad debts written off, including a loan to a deceased employee. Okay, so obviously you've written off, all right, bad debt, and including a loan to a deceased employee. Right, if this is a loan, okay, obviously you're writing it off, and this is a deceased employee, so there is no note here. So based on this, you would expect, okay, for there to be some sort of distinction between what was the loan portion and what was the bad debt. But this is bad debt. Bad debt basically indicates that you have or you had outstanding amounts that were owed, okay, to the business, okay, to the organization, but that portion wasn't received. Okay, so if that portion isn't received, obviously there's going to be some sort of deduction based on your general operations, okay, your section 11A. So this 26,700 would be a general deduction, okay, section 11A, bad debts. Right, so I'm writing off what I couldn't collect, 26,700. Right, minus 26,700. Is that right? Yes, minus 26,700. Cross that out, move on. Okay, provision for doubtful debts, current year. Okay, so there's a current year portion, and there's obviously going to be some information here because I see a note. 400,000 is the current year. Okay, so let's go look at line number 3. Okay, here's it. Provision for doubtful debts. The doubtful debts provision for the current year was, right, if it's the current year, obviously if it's the current year, you're going to be able to claim a portion of this provision because based on the legislation, SARS will allow you to claim up to 25% as a deduction in the current year. Right, again, you can go to your textbook notes and you can search for it. Okay, just to show you this, provision for doubtful debts. Doubtful debt, not coming up. Bad debt, maybe. Let's just go provision. Okay, provision, provision, provision. There. Okay, have a look. Doubtful debts, right? Provisions. Here's the notes. The 40% and the 25% doubtful debts allowance calculation is only applied to the list of doubtful debts, not to the full debtor's balance. Okay, so obviously you're only going to be providing for the actual provision based on the provision amount, not the total. And that would make sense because the total would fall outside the scope. Let's just see. Yeah, that was it here. No other examples. All right, it's a pity they didn't give you an example here just to show it. Maybe there is one later on in the workings. Let's see. Here's one. What question is this? Here, question 5.2. You guys can go back and you can look at this to revise. Right, so obviously you can see here that there are debtors here. You've got bad debts that recovered. You've got a list of doubtful debts. Right, you've got debtors balance at the end of the year, and you've got bad debts for the last 2 years. Okay, so let's just show you here the provision part. Okay, they want the income tax. So 5.2. Okay, let's just try find this. Let's go 65. Okay, there's solutions. Okay, where's 5.2? Here's 5.2. All right, here you go. You guys can see it. All right, there. Doubtful debts allowance. Okay, the previous year, the current year. All right, you can clearly see that there's that 25% of the actual provision that needs to be provided for. Obviously, last year you would have claimed the deduction, so this year you need to add it back. That's why it's a positive. Right, this year you're going to claim 25%, and that's why it's negative. Right, so that shows you clearly how to do the deduction. It's always nice to reference your content so you guys can practice applying the theory as best as you can. Okay, so hopefully that clears that matter up and you guys can just apply it as is. Doubtful debts provision for the current year, 400,000. So current year provision for doubtful debts, 25% of 400,000. It's a deduction because it's the current year's amount times 25%, 100,000. Right, and then you would copy paste this. Okay, previous year provision for doubtful debt. Okay, what was the previous year's doubtful debt? A doubtful debt allowance. Okay, so they say this was the allowance of 95,000 was claimed. Okay, so if it was claimed the previous year, you would have to include it in the current year. 95,000. Complete. Okay, next. Salaries and wages. All right, number 4. Okay, there's a total here, 1.256 million. Let's see what the note says. Okay, salaries and wages. Expense includes an amount of 125,000 for the employee pension fund contributions. Okay, so what am I looking at here? Well, I'm looking at salaries and wages that I have paid. Okay, the payment amounts to the total here, the 1.256 million, right? That's the total that you have as the actual salaries and wages line item, the figure. Okay, but within that figure, you have an amount of 125,000 for the employee pension fund contributions. Okay, so obviously, you as the employer, okay, are paying that total, all right, in terms of salaries and wages, right? And this total includes an amount of 125,000 for employee pension fund contributions. Notice they're employee contributions. They're not employer contributions on behalf of the employee. So that's something to consider. So if I'm looking at this, right? The salaries and wages would be a normal Section 11A deduction, okay, less the employees, okay, pension contributions. Right, because it's not the so for example, if it was the employer paying a portion towards the employee's pension contribution as an additional contribution, then I would include that as a separate line item. Right, so I'm going to mention that, okay? Let me type it as employer contributions, okay, to the employee pension. Okay, I'm going to show 0 here. There weren't any. All right, none, null. Right, but there were salaries and wages. So you need to show a working here. It's going to be brackets the 1256. I think that was the right figure. Let's just go back and check. Yes, 1256, eh? 1256, yes. Okay, less the 125. Close brackets. I think let's move this across. Okay, so minus 1256000. All right, take out the 125,000. Right, and that's going to give me that figure as the deductible Section 11A salaries and wages deduction. Okay, as a normal operating expense. Right, so again, the reading here is quite important. Right, I hope UNISA hasn't interpreted this as being the employer's contribution to the employee's pension fund. Okay, that wouldn't be correct. Okay, then you would have to record a separate employer contribution to the employee's pension fund. Right, again, maybe just to show you this, let's go pension. Okay, that should find it. Here. Here's an example. Question 6.2, contribution to the employee's pension fund. Okay, see. Let's go look for more. Here. Blueberry's employees belong to a company's pension fund and medical aid. Blueberry contributes to these funds on behalf of the employees. C. During the year, contributions on behalf of the employees to the pension fund amounted to that, and the medical fund amounted to that. Salaries of that also occurred during the year. Right, so you guys can clearly see in this question, this was 5.3. All right, so in 5.3, you had pension contributions here. This was on behalf of the employee. See, on behalf of the employee. In other words, the company is paying, all right, a contribution towards this fund in addition to what the employee is contributing. So 5.3, let's just go back to, what is it, page 65. 5.3, just to show you this. 5.2, 5.3 here. There, contributions to the pension fund. Okay, but on behalf of the employee. All right, let's just see if we can find some theory for you guys just to revise this concept. That would have actually have been, yeah, chapter 5 would have been the right chapter. Let me go back to chapter 5 and just show you what I am referring to. Here, general deduction formula. Let's see, where are you? Production of income, capital of nature, not this is all theory, VAT, legal expenses, restraint of trade, copyrights, no, where is it? Bad debts. Here, there we go. There's the note. All right, in your textbook, okay? Contributions made by an employer to pension, provident, and benefit funds. All right, you can clearly see here that it's the employer making the contribution to the employee's provident or pension or benefit fund. All right, so all contributions to these funds are deductible. See, as long as it is incurred in production of income. All right. Note, a benefit fund includes any friendlier society registration registered under the Friendly Societies Act, okay, or medical schemes. All right, so you can clearly see here that we're referring to the deductions, okay, made by the employer to the employees fund, not the employee's contribution. That's different. Okay, if the employee is the one contributing to his or her own pension fund, then that's a personal income tax deduction. Right, they would have to submit that on their income tax return. Okay, there might be some examples here, maybe just to show you. Is there? No, there isn't. Okay. All right, so again, always refer to your notes. That's always important. I'm just trying to do some revision here as well so you guys can see the thinking behind it. Next, travel expenses. Number 5, 60,000. Let's go look at note number 5 here. Travel expenses. The marketing director traveled overseas to attend a sustainable environments conference in India. His wife accompanied him on the trip. The overseas trip cost the company 60,000. Okay, so the company is paying for the trip. That's important to note. Okay, so this is kind of like a fringe benefit, but from the company's point of view, they would be able to claim this because this is for business. You would be able to claim a portion of this only for the director, so the 40,000. Okay, the marketing director had 40,000. The wife had 20,000. So the overseas trip would obviously be deductible, but limited to what was for business, okay, as a section 11A. Right, so business travel, deduction, okay, bracket 60,000 minus 20,000, asterisk for the wife, not or non-deductible. Okay, you're not going to be able to claim the wife's travel expense as a deduction, right? That wouldn't be fair. So 60,000, okay, less, so take out the 20,000. Okay, it gives me 40,000 as a deduction. Right, that's the deductible amount in brackets. That was an easy one. Okay, there are some easy, and they are obviously more difficult depending on how you're looking at it. Okay. All right, next one, advertising prepayment. As soon as I see prepayment, I'm thinking prepaid expenses. Okay, so this is giving me an indication there in terms of the note. Okay, so this tells me I need to look at note number 6. It's 380,000. So 380,000 is representing the total. Okay, what does it say here? Here. Advertising prepayment, okay? The business prepaid 380 for various advertising mediums, all right, for the period 1 July to 31st June. Okay, so 1 July to 30 June. Okay, July to June 2019 to 2020 is a full year, so 12 months. All right, that's important to note. Okay, so I've got 12 months here. Right, the first thing we need to check when looking at prepaid expenses is the prepaid expense greater than 6 months? Well, yes it is. Okay, 12 months. Right. Is it less than 100,000? No, it's greater than 100,000. Right, so if it's less than 100,000, right, it would be taxable in full, okay, not taxable, deductible, right, in full, right, if it was less than 100,000, right. So this comes back to our deduction notes here. Let me show you these deductions. There we go. Here, prepaid expenses, okay, less than 6 months, all right, or less than 100,000, you would be able to claim that as a deduction. Right, so you need to look at either or. If we're going back to the textbook, we're going to have to look at section 5, the prepaid, the special deductions. Let me see if I can find that for you guys, and let me show that to you here. Okay, if you have a look at the notes, it says here, in terms of section 23H, prepaid expenditure may be claimed in the year of assessment that the full payment is made if, there's the keyword if, The prepayment amount relates to a period within 6 months. Is this within 6 months? No, it isn't. Okay, or, meaning either or. Right, so it doesn't meet that requirement. Or, is the aggregate amount less than 100,000? No, it isn't. It's greater than. So if it's greater than, you'd only be able to claim for the months within the year. Go back. There we go. Okay, 380,000. We need more space here. You can see there's lots of deductions. Right, prepaid. What expenditure was this? Advertising. All right, prepaid advertising expenditure. Brackets, 380,000. Okay, 380,000. Right, I need to do the check. Check. 12 months greater than 6 months. Okay, or 330,000. Okay, not less than 100,000. Right, so because it's not less than 100,000, you cannot claim the full amount. So I'm just going to put a note next to it, asterisk, cannot claim the full deduction. Okay, so you need to apportion it. All right, so how am I going to apportion that? Well, let's work it out. Brackets, 380,000, okay, divided by 12 equals. Per month. Right, when did we start this? 1st of July, hey? So that was 2019. Right, let's just go look at our year. 1st of March. Okay, so how many months do we have in the year? So July is in the middle of the months, middle of the year actually. So from July to the end of the year, we've got July, okay, July, August, September, October, November, December, January, and February. I count 8 months. Okay, so times it by 8. That gives you that portion. Right, so obviously the tax year is from 1 March 2019 to 29 Feb 2020. If I'm looking at this prepayment which took place during the financial year on the 1st of July, okay, I'm only going to be able to deduct the portion that relates to that year. Okay, so how many months are within the year? 8 months. Okay, so July, August, September, October, November, December, January, February. Okay, that's 8 months. That's correct. So then this portion, so the 253,033 cents with the 33 cents, okay, will be deductible. Where am I? Here, next bit. Question. The end. Next line item, low cost residential units. Okay, this is obviously a capital allowance. Okay, we've looked at this in our theory notes. Okay, so low cost residential units, 1.35 million. There is a note, so I'm going to refer to it. Number 7. Here, low cost residential units. They say a housing development close to the premises commenced in 2018. Okay, that was obviously the prior year and was completed in April. So it was completed. So in other words, it was completed in the current year. Okay, April, right, which is the second month of the current year. The company purchased 6 units from the developer for a total of 1.35 million. These units are defined as low cost residential units in terms of the Income Tax Act. Okay, so we do have low cost residential units applicable here. Again, go to your notes, not this set, these sets. Let's go to the deductions here. Okay, immovable assets. Right, building only for manufacturing, not what I'm looking at. Commercial, not what I'm looking at. Residential, yes, but this is low cost residential. So it's the next one. Okay, section 13 sept, low cost residential units. Okay, in terms of the loan account, 10% of the amount owing. Post 21st October 2008. Okay, well, there's no problem with that because the date is obviously later on. Right, but we need to look at this whole idea of a loan account. So I just want to show you an example so you guys can understand this concept in more detail. Okay, low cost residential. Here, low cost residential units, section 13 sept. Right, there's the summary. If we go look at the actual section, there's it, sept. Okay, residential units, section 13 sept. Right, a residential unit is defined as a building self-contained apartment, okay, obviously for residential purposes, right? That's important. Okay, they tell you to refer to the textbook so you guys can have a look at the content in the textbook. I just want to show you the actual deduction. Is there an example here? Let's see. This is the quat deduction. No. We're probably going to have to look at the textbook examples again. Yeah, it looks like it. So let me scroll further down. Is there any low cost residential? Not in that one. I think there might be one here. Okay, that's manufacturing. Nope, nothing there. Yeah, 6.4. This looks like one. Right, we've got an admin building. Is there any low cost residential? Unfortunately not. And that's it. Low cost residential. Let's see what the search option can find. Okay, it doesn't find anything. Alright, so it looks like unfortunately the study guide doesn't actually have any specific examples that you can actually utilize or look at. So I would refer you to your textbook and you can then consider what's in the actual textbook to then apply that to the scenario. So if you go look at the textbook, just to reference it, let's have a look. They say low cost residential unit. Where the unit qualifies as a low cost residential unit, the taxpayer may claim an annual deduction of 5% over 20 years. Okay, or 10% over, is it 10%? No, 5%, yeah. Instead of 5% over 20 years. Okay, may claim an annual allowance right, over 10 years instead of 5% over 20. Okay, so that's the two considerations. Right, in terms of the Income Tax Act, a building qualifying as a residential unit, okay, that's just the definition, you don't need that. Where the building is to let, the owner must, that's for the actual application, no, that's not relating to the deduction. Okay, here on the next page. Deduction in respect, okay, of the capital allowance. All right, the cost is at arm's length transaction, which is what we saw. Okay, that's the actual amount that was acquired. All right, they also give you a little note here, 55% of the acquisition price where the unit is acquired. Okay. The taxpayer, the cost of the allowance is based on, okay, 55% of the acquisition price where a unit is acquired. 30% of the acquisition price where an improvement is acquired. Okay, I didn't acquire an improvement, I acquired a unit. So if we go look at the textbook and we then apply that to the question, did we acquire this or did we improve it? A housing development was or started and completed. Okay, the 6 units were purchased. There's the keyword, purchased. Okay, so let's go to our working. Okay, low cost residential units purchased. Okay, equals. All right, because this is purchased, it was acquired. So 55% of What was the total cost? 1.35 million. Okay, times a allowance. All right, in terms of the low cost residential allowance, we would have to then deduct a portion of that cost, all right, on a year basis. Let's get the amount. Remember, it's a deduction, so negative. In other words, in brackets. Okay, 10% is the deduction of the 55% of that amount because this was acquired. Next question. Patents, okay, this is 650,000. All right, so what does the patent say? A patent valid for 5 years was purchased by the business for 650,000, and that took place on the 1st of March. Okay, that's important as well, okay, because of the dates in terms of March 2019 is the start to Feb 2020. Okay, so that would have happened, let's see, that's 19, it would have been 2016, then 2017, then 2018. This is 29. So 1, 2, 3. This would be the third year, because that's the first year. Yeah. So that's the 1 year, 1 year, 2. That would be the third year. Okay. So it's valid for 3 years. Okay. It's a patent. Right. So with patents, we need to look at this whole section. I think it's GC or GB. Let's just get the right number. Okay, in terms of patents, here, this is section 5, yeah, registration, acquisition of patents, perfect. Okay, you can see here, expenses relating to intellectual property, for example, patents, copyright, and designs are of a capital nature, and they will not qualify as a deduction under section 11A. Right, we know how important that is. Remember, section 11A is looking at those general deductions. If I'm looking specifically at a patent or a copyright, patents and copyright are considered capital in nature, so they would never ever be considered as part of the general deduction formula. So that's why you have to take those allowances, and you need to provide for them as a special deduction. So special deductions are applicable only for unique situations, okay, for items that are specifically deductible, okay, based on the rules and regulations covered in the Income Tax Act. So if I'm looking specifically at a special deduction here, which is a patent, I then need to apply the legislation correctly. The legislation is going to outline how much of this you can actually deduct, and that's important because if you're looking at a patent, sometimes you can't deduct the full amount, you can only deduct a portion, and that's something to consider when looking at items that are of a capital nature. So when looking at those deductions, okay, just to show you this, acquisition of patents, copyrights, and designs, right, you'll see here, expenditure less than 5,000, okay, expenditure more than 5,000, right, and then they were obviously separated according to the 3 different types in terms of patents, copyrights, and designs. There's just a note here as well. Note that the allowance of 5% or 10% is deducted every year, not only in the first year, right, until the full acquisition cost is claimed. Okay, so if you are purchasing a inverted commas capital asset and you've got the special deduction, it actually benefits you to register patents and copyrights because of this deduction. Right, it's part of business, but it's capital in nature. Okay, so that's the theory relating to that. Okay, well, while I've got this slide up, you guys can see that there's obviously a 5% deduction here that's going to be applicable. So let's go and include that here. Okay, patent. Right, this was a patent that was acquired. %5 of, what was the amount? 650,000. Minus 650,000 times 0.5%. Okay, there, 32,500. Perfect. Next. Office construction and factory. Okay. Number 9, 350,000. Office construction and factory. Offices were built next to the existing factory building. Okay, so it's not the factory, it's offices. So that would be non-manufacturing, okay? By SLS during the year at a cost of 350. It was completed and brought into use on the 1st of October. Okay, that date's always important because you need to look at the year. It was brought into use during the financial year, or the tax year, I should say, and that's fine. We will obviously apply a deduction here, potentially in terms of capital allowances. The factory building was purchased new in June. Okay, so June it was purchased new, and that was for 2 million, and was wholly for the manufacture of solar powered lights. Okay, so there's two buildings here. Okay, obviously office, okay, factory. SLS claims the building allowance on the factory. All right, so this is looking at right of period. Okay, no, that's something else. That's wear and tear allowances, but that doesn't apply here because we've already claimed a capital allowance previously. Okay, so we don't need the other information. We need to go look at the actual capital allowances here in terms of the buildings. Come number 6 there. Okay. Previous slide, this one. Okay, mainly manufacturing. That's important. Okay, so remember we had purchased a building that was in 2012, right? 2012. That's the factory. The factory was purchased for 2 mil. Okay, that 2 million is post 1989, so there will be a 5% allowance that will be claimed on that building. So 5% of 2 million. Factory building, 5% of 2 million. Minus, because it's a deduction, 2 million. How many zeros are there? One more. 6, yes. Times 5%. 100,000. Okay, then we have a commercial building. 5% per annum must be for the purposes of a trade, so in production of income, which it is. It's post 2007, which it is. Okay, so if I'm looking at the office, okay, I'm going to then apply the 5% to the office that was created, the 350,000. That was during the year, so that's fine. Okay, I just want to show this summary here in the actual notes that can maybe help all of you in terms of theory. You guys can see there's a really good summary here looking at capital allowances of immovable assets, so in terms of building allowances. Right, we spoke about the manufacturing building, okay, which was the 5%. Okay, here's the low cost. See, there's it there. Okay, low cost residential, 10% of the amount. Oh, okay, I see the actual 55% doesn't apply for the low cost residential. So I need to correct that. Here, the low cost residential. This 55 needs to come out actually because this was only for the commercial buildings. Okay, I need to correct that. Take out the 55%. Right, 10% of the cost of the residential. Okay, we're looking at the commercial building, this one. Okay, administration building. Right, on or after 1st of April, okay, 5% not a portion. All right, that's the one that we're actually looking at here because of the office. Maybe just to show that note that I was referring to here. Okay, commercial buildings. Right, that 55% relates to the acquisition. Okay, please note that when part of a building was acquired by a taxpayer without the taxpayer erecting or constructing it, it must be adjusted as follows. Okay, 55% of the acquisition price if only a part is acquired. 30% of the cost of improvement if an improvement is made. Okay, and that applies to the commercial buildings. All right, the low cost residential, that was separate. Okay, we had low costs earlier. I had incorrectly applied that by mistake. All right, so now that we've clarified that, maybe just put in the amounts. 350,000. Times 5%. Again, it's a negative in brackets, in other words, times 5%. 17,500. Great. Is there anything else? No, there isn't. Okay, other information, we spoke about that. That would be a Section 11E wear and tear allowance. Okay, wear and tear doesn't apply, okay, when you've already claimed capital allowances for those assets that you had purchased or used. Okay, so that wouldn't apply. That you need, okay, in terms of the tax tables, this is obviously progressive. So you need to account for the actual tax liability of this company. We can delete some of these lines just so you can see the whole solution. Right, there is no taxable capital gain, so 0 here, because you had not purchased, well, not have sold, okay, any items that you had purchased, right, in terms of more than its tax value or carrying value from an accounting point of view. Right, income, sales, interest, total income, deductions and allowances. Okay, the rent, and then we've got all of these deductions. We need to add them up. Right, I'm going to round it off to the nearest cent. And then I'm going to take the total income, less the deductions and allowances, add no taxable capital gain, and that gives you taxable income of let's make that a rand figure, 1.953 million. Okay, 786,097 cents. Okay, now you're going to apply the tax tables. So I'm going to go to the question. I'm going to just take the content that's here just so that you guys can see how I'm actually accounting for the tax liability. That's what they wanted you to calculate. That's important. Because this is an SBC, you're obviously going to work out the tax based on a sliding scale. So if I'm looking at the sliding scale, where am I? I'm at the last point there. So in other words, tax equals 58870, okay, plus 28% of, open brackets, the taxable income exceeding 550,000. So 1,953,786.97 less 550,000, close brackets, equals. Okay, just to show additional working, so you guys are familiar with how I'm getting these figures. Okay, this bracket should be 1,403,787. There might be some cents there actually. Yes, there is. Okay, so let's leave the cents there. 86.97. Right, and then you do another working. 28% of this is that figure there. 393,060.35 equals that final answer there. Okay, so just to sum up, the SBC will pay or will have a tax liability of in rands. And that's how you do the question.